Greetings to everyone. I am Vedant Naik, currently pursuing Masters in Construction Engineering and Management at CEPT University. My student code is PCM23425. I would like to begin by introducing my research project titled Assessment of Industrial Real Estate Financial Viability via Private Equity. This research is centered around evaluating structured investment models in India's industrial warehousing sector with a focus on Ahmedabad's evolving logistic landscape. This DRP is guided by Mr. Anup Shah, who has 15 plus years of experience in industrial real estate and industrial deals. So, let us dive into the financial viability of industrial real estate via private equity. Starting with the introduction, the industrial and logistics sector in India has undergone a transformative shift in the past few years, largely driven by e-commerce expansion, rising third-party and logistic demand, and strong policy reforms such as National Logistic Policy and the Gati Shakti Master Plan, and also the Production Link Initiative schemes. These frameworks have not only reduced logistic cost but also catalyzed Grade A warehousing growth across the Tier 1 and Tier 2 cities. To put this in context, India show a 1.4x demand to supply ratio for warehousing in H1 2024, showing how rapidly this segment is evolving. Within this wave of infrastructure driven investment, Ahmedabad has emerged as a key logistic hub, witnessing a 22% year on year increase in demand, especially in Sanand, Changodar, and Aslali. In response to this rising interest, private equity has become a critical financial engine with an 18% compound annual growth rate between 2018 to 2023 and a total investment crossing $8.5 billion. PE firms are no longer limiting themselves to residential and commercial segment. They are actively financing logistic parks and warehousing cluster, prioritizing IRR based exit and capital rotation. Now, to understand this landscape in a data driven way, I formulated a clear set of research objective and a need of study. First, to evaluate the financial viability of industrial real estate through private equity using indicators such as IRR, cap rate, and rental yield. Second, to assess the market potential of Ahmedabad through detailed benchmarking of land rates, absorption trends, and the vacancy rates. Third, to compare short-term exit model with a long-term holding models such as land leasing strategies to identify scalable investment frameworks aligned with the PE expectations. Let me now walk you through the methodology which we have adopted. This research followed a mixed methodology approach, combining both qualitative inputs and a quantitative modeling. The study commands with a primary data collection, including expert consultation with senior professionals from CBRE, JLL, and leading developers. Their insight on PE structuring, exit preference, and rent escalation cycles help shape the assumptions used in financial models. In parallel, secondary research drawn from the top industrial publications such as JLL, CBRE, and Knight Frank, and some policies. These reports provided critical macro-level data on logistic absorption rates, rental growth, and land value appreciation. A market benchmarking exercise was also conducted, comparing Ahmedabad to Pune, NCR, and Bangalore. This confirmed Ahmedabad's edge in the terms of competitive land rates, improving rental yields, and emerging supply clusters in Sanand and Behcharaji. Following this, I developed three financial models. First, a 5 years JV model, a 7-year JV model, and a 30 years holding strategy with a two variations, land purchase and land lease. Each model incorporates phased debt injection, rental escalation assumptions, exit via cap rate based valuation, and a sensitivity analysis across rental growth, interest rate, and a cap rate fluctuations. Finally, a comparative inference across all models was drawn using IRR, capital efficiency, and risk adjustment return parameters to determine which strategy best aligns with the institutional investment goals. To summarize this slide, the study does not merely analyze isolated numbers. It integrates real market behavior, funding strategies, and a policy to build replicable and a scalable financial framework for a private equity in industrial real estate. Let us now move to the slide 2, where we will explore the evolution and the current overview of the Indian industrial real estate market. In this slide, I will be walking you through the core literature insights that provide the foundation for understanding India's evolving industrial and logistic real estate sector, both from the historical and the investment standpoints. Let's start with the evolution timeline of India's industrial real estate. The growth of this sector truly accelerated post 2005 when the Special Economic Zone Act was introduced. This legislation formalized industrial clusters across India and allowed for integrated industrial development. But the real shift comes post 2020 when global private equity funds started flowing into India. This marked the institutionalization of industrial real estate characterized by built-to-suit parks, ESG compliant infrastructure, and global warehousing standards. Today, India's logistics sector is not just a support system but a high performing investment avenue in itself. Government support has played a big role in growing India's industrial, logistic, and warehousing sector. Some important steps taken by the government have helped speed up this growth. Allowing 100% foreign investment in warehousing and logistics has brought in large global investors. The dedicated freight corridor have made a movement of goods by rail much faster and more efficient. The production linked initiative scheme has supported local manufacturing and increased the need of nearby warehouses. The National Logistic Policy aims to bring down logistic cost from 14% of GDP to the 8 to 9%, making the system more cost effective. Because of this step, the sector is now attracting more investors. In fact, over $10 billion in private equity has been invested in the sector since 2017, and the number continues to grow. Let's now look at the graph on this side. The first graph shows the total warehousing space in India's top 8 cities. As per JLL 2024 report, India shows a recorded high of 15.3 million square feet of warehouses deal in financial year 2023. This was more than the deals in the office and housing sector after COVID. The three biggest regions, Mumbai, Delhi NCR and Pune, make up over 65% of the all warehousing space. This shows that demand for warehouses is strong and steady and less affected by the normal real estate ups and downs. The second graph shows the trend of supply and demand. Here we see that demand has been higher than supply in almost every year. In the first half of 2024, the demand was 1.4 times more than the supply, meaning there is a tight market. This is good news for warehousing owners and investors. Cities like Ahmedabad and Nagpur have big gaps between supply and demand, making them good place to invest. As the demand stays high, rents are expected to go up, giving better returns on investment. The third graph compares absorption versus supply in 2023. While cities like Chennai and Bangalore have seen oversupply, making them as a buyer's market, cities like Ahmedabad, Indore and Coimbatore shows greater absorption than supply, defining them as a supplier-driven market. This positioning market tier 2 and tier 3 cities extremely attractive for development and long-term PE investments. To sum up, India's industrial and logistic market is experiencing a structured transformation supported by favorable policies, evolving infrastructure, and rising investment trend. The literature clearly indicates that Tier 2 market like Ahmedabad offers a rare combination of affordable entry, rising rents, and demand-supply imbalances. These factors collectively justify a deeper financial exploration which were carried out throughout the study. Continuing our literature review, this slide brings focus to two essential pillars driving India's industrial real estate evolution: the overall market dynamics and the role of private equity. Now, if we look at the average rent and year-on-year change graph, we observed a key insight. While markets like Mumbai, Pune, Chennai command high average rents of rupees 23 to 25 per square feet, their year-on-year rental growth is relatively muted, often under 5%. In contrast, emerging hubs like Ahmedabad, NCR, and Bangalore exhibit lower rental bases but much higher revenue growth, 5% to 8%. This inverse trend indicates that secondary markets are entering a value appreciation phase, making them highly attractive for institutional investors who are betting on further scalability. Next, moving forward with the private equity in industrial real estate, we examine the graph showing the share of supply addition by domestic versus institutional developer from 2020 to 2024. The transaction is stacked. In 2020, nearly 80% of the warehousing supply was contributed by the local or the standalone developer. However, in 2024, the share of institutionalized backed developer jumped to 52%, reflecting a clear shift towards organized, well capitalized platforms. This change signifies the market's maturity, increasing appetite of compliance, quality standards, and ESG aligned development, all of which appeal to global capital. For instance, platforms backed by Blackstone, ESR, Indospace, and CPPIB now dominate the landscape, replacing the fragmented past with institutional grade asset creation. The final graph depicts PE investment in Indian warehousing, which reached $8.5 billion between 2018 and 2023, going at CAGR of 18%. PE investment reached $1.87 billion in 2024, recovering strongly after a dip in 2023. This influx has been concentrated around logistic parks, cold storage, and last mile delivery centers, especially in locations benefiting from policy supports like PLI scheme, Make in India, and Gati Shakti infrastructure rollouts. The takeaway here is that private equity has not only funded by shaped the trajectory of industrial real estate, from infusing liquidity to catalyzing development standards. It has helped industrial real estate becoming a core component of India's economic infrastructure. Now we transit next to the slide 4, where we will zoom into India's Ahmedabad industrial real estate market, its micro market dynamic, leasing trend, and investment hotspot. Moving into the regional focus of this research, this slide presents the Ahmedabad industrial and logistic market analysis, which forms a critical foundation for our financial modeling and investment scenario testing. Ahmedabad has emerged as a leading tier 2 city in India's warehousing and logistic landscape thanks to its strategic location, connectivity to ports, and integration within the Delhi Mumbai industrial corridor. The city has been experiencing 22% year-on-year growth in warehousing demand, and this sharp uptick in supported by rising infrastructure readiness and active policy push. Let's begin by understanding the regional market performance. As represented in the map on the left, the map identifies key micro market within the Ahmedabad, namely Sanand, Changodar Bavla, Aslali Kheda, and Becharaji Vittalpur. These sub-markets have been primary hubs of Grade A industrial and logistic development, and our analysis is focused on this cluster. Looking at the graph on the top right, which shows the supply and stock trends across this sub-market from 2015 to 2024. A few trend standouts, like Aslali Kheda leads in terms of total leased area, crossing 9.8 million square feet, showcasing consistent tenant demand and strong leasing traction. Further, Becharaji Vittalpur, although less mature, has lowest vacancy rate of just 8%, despite having the highest supply addition in recent years. This indicates strong demand-supply balance and market absorption strengths. Changodar and Bavda too emerging rapidly with the significant leasing opportunities and future development potential. While Sanand, despite being an early mover, currently has a higher vacancy but major upcoming supply pipeline that the position it well for the future. Now if we look at the bar graph in the bottom, it shows the distribution of supply versus absorption share in each of these micro markets as of end of 2024. Aslali Kheda dominates with 45% share of total supply and 56% share of total absorption, indicating it is currently the most mature and active market in Ahmedabad. Changodar Bavda, despite having only 15% of the total supply, accounts for 22% of the total absorption, revealing significant pent-up demand and growth potential. Vittalpur, Becharaji and Sanand show relatively balanced dynamics, but Sanand's future pipeline and land availability give it long-term upside. Further, if we consider the rental dynamics, which we'll explore in more detail, Sanand commands the highest average rent at 25 rupees per square feet per month, but also faces higher vacancy. In contrast, Changodar is growing rapidly with a rent escalation of nearly 20% year on year, reflecting its transaction into the warehousing zone. Furthermore, now let's move to the slide 5. This slide delves into the real-world application of private equity investment in the Indian industrial real estate sector, with a particular focus on deal structuring and the operational models. Additionally, we supplement this financial lens with a ground-level case studies from the industrial parks in Ahmedabad, which inform the assumption used in our project-level financial models. Let's begin with the two major deal study presented on the left side of the screen. Blackstone and Alcagro deal. This was the full acquisition model where Blackstone took over income yielding asset developed by the Alcagro. Post acquisition, Alcagro reduced its operational role, enabling Blackstone to directly manage and optimize the asset portfolio. Key benefits. This deal structured allowed for immediate capital infusion and the Blackstone gained full control of asset, aiding rapid portfolio integration. Challenges. It did come with a long-term lease obligation and reduced flexibility since Blackstone had two inherent operational framework already in place. This case reflects a core strategy ideal for investors seeking a long-term income from the stabilized asset but less sustainable for those seeking a development upside or flexible exit points. Further, with the second case, Indospace and CPPIB joint venture. This is a joint venture development model with a developer retaining partial control and CPPIB entering as a strategic co-developer. This kind of structure allows shared risk, phased investment, and gradual value unlocking. Key benefits are risk is distributed between both the parties. CPPIB benefits from stable income flow while Indospace retains execution control. Challenge is complexity in profit sharing, decision making delays, and the potential execution risk remain higher compared to full acquisition model. Together, this deal studies highlights the two ends of the private equity spectrum: core income models versus the opportunistic development models. For our project, we adopted a JV approach similar to the Indospace model with a shared equity and defined roles, as it allows greater alignment between developer capability and investor risk appetite. Now moving to the right half of the slides, we shift our focus from capital structuring to the phase characteristic and a special analysis of industrial parks in Ahmedabad. This section is crucial because financial feasibility is grounded in realistic development and operational data. Uh, I have done a site visit across 10 industrial parks in Sanand, Changodar, Bauda, Khoda, and Bechraji Vithalpur. These visits provide us with the real-time data on land utilization patterns, project phasing, and tenant demand characteristics. From these site studies, we identify consistent design typologies such as use of pre-engineered building, clear height of 9 to 12 meters, and the unit size ranging from 40,000 to 1 lakh square feet. This modularity is critical for accommodating a diverse tenant base, including third-party logistic, FMCG, automotive, and e-commerce player. Further, we created a land area distribution table where 50 to 60% of the land is allocated to the warehouse structure and 20 to 25% to the internal road networks. The rest is divided among the common open space, parking, support infra, and services. This helped define our efficiency ratio and influenced our cost estimation per square feet for the main model. Furthermore, deal structuring gives insight that joint ventures are increasingly preferred over full acquisition by private equity funds, particularly when land or infrastructure execution is complex. Our choice of JV model with a shared equity aligns with this trend. Site level learning. Average warehousing size, parking provision, and road width, and the infrastructure allocation shapes our assumptions around construction phasing, cash outflows, and rentable area efficiency. Further, the tenant demand patterns shows sectoral diversity in Ahmedabad's industrial clusters, supports multi-tenant leasing models, allowing for phased lease and diversified rental incomes. Learning from the site visits and PE-backed deals together inform the split between upfront capex, debt tranches, and rental income structuring, which we implement in our short-term and long-term financial models. In summary, this slide builds the bridge between the financial theory and the ground reality. The deals tell us how capital behaves, and the park shows us how projects breathe on the ground. Now that we have understood the market potentials, the slide transition us to the core project selected for the financial modeling. Project is located in Charal, Ahmedabad. This industrial and logistic park is strategically placed within the thriving Sanand cluster, a region known for its manufacturing strength and connectivity to the Delhi-Mumbai industrial corridor. The project spans 41.4 acres, housing 7 industrial units with a total built-up area of approximately 10.4 lakh square feet. Designed to cater to e-commerce, automobile, third-party logistic, FMCG, and manufacturing tenants. The layout supports modular scalability, warehousing flexibility with a clear height of 9 to 12 meters and unit size ranging from 4,000 to 1 lakh square feet. Coming to the cost structure, the total development cost is 207 crore with the 109 crore allocated to the land acquisition cost and 97.67 crore towards the construction and the infrastructure cost. In line with real world investment structures, the project is funded via joint venture model with a equal contribution from the PE investor and the developer. The private equity shares include 54.85 Cr for land and 30.1 Cr for construction equity, totaling it to the 84.95 Cr. The rest of the construction cost is covered via debt of 145.16 Cr distributed in 4 tranches to align with the construction milestones. This minimizes interest burden during early development and keeps the capital cycle tight. The flowchart represents the model which we have used for the financial viability. Also, the stamp duty is considered in the total land cost, which is 6.5%, and the GST is also considered for the construction cost. Now moving to the slide 7, we delve into the core financial model built around a short-term joint venture strategy with a 7-year exit horizon. The slide summarizes the assumptions, project timeline, and a detailed cash flow patterns for the base case of the 7-year model. Starting with the assumptions, the joint venture is structured with a 50% private equity stake. The land cost borne by the private equity partner stands at a 54.85 Cr, which is 50% of the total land cost of 109.71 Cr. The construction funding follows a 30-70 equity to debt ratio, with the debt component bearing an interest of 9.5% and a tenure of 10 years. On the revenue side, rental income has been assumed at 25 rupees per square foot per month for a leasable area of approximately 10.5 lakh square feet. This results in annual rent inflow of 31.20 Cr with a rental escalation of 15% scheduled every 3 years. The planned exit happens at the end of the 7 year based on a cap rate of 8.5% with an exit value calculated as the net operating income divided by the cap rate. Let's now look at the timeline. The project has starts in H1 of year 1 with a land purchase, design and initial development. Construction is phased over the next 3 years with 25% of warehousing completed in each half year until the year 3. Leasing also happens in phases starting in year 2 and reaching full occupancy by year 4 H1. Importantly, the scale at cap rate is scheduled for H2 of year 7. Now focusing on the cash flow pattern, the total project outflow stands at 207.37 Cr with the construction and infrastructure expenses front loaded across the first 3 years. The debt is drawn in a 4 tranches of 36.29 Cr each, aligned with the capital expenditure schedule. This staggered distribution helps manage interest burden and keep the funding cycle tight. Rental inflow starts in H1 of year 2 and the gradually ramp up to the stable high yearly inflow of 17.93 crore by year 5. Cumulatively, rental revenue over the holding period touches nearly 179.6 crore, which supports ongoing debt servicing and JV cash flow stabilization. What's important to highlight here is that the model initially operates under a negative cash flow until mid-year 4 due to intense capital deployment. However, by year 4 onwards, the rental income begins to surpass outflows, making the project cash flow positive. A bullet repayment of 71.63 Cr is scheduled at the end of year 7, which is supported by the asset sale value of 422.06 Cr. This terminal event ensures a robust capital release, marking the successful conclusion of the project cycle. The internal rate of return or the IRR under this base case stands at 16.58%, while the IRR is strong for core industrial asset. The returns appear limited when analyzed against the capital uh, intensity and market growth opportunities. These insights led to development of the 5 years model, which I will explain in the next slide. But before that, it's worth nothing. The 7th year model is still valuable for core plus investor or a long holding institutional funds seeking stable income with lower reinvestment pressure. However, for private equity investor aiming for a quicker capital turnover and strong risk adjusted returns, this model might fall short. In essence, this 7 year structure presents a safe, moderately rewarding strategy with a strong capital security but limited IRR scalability. Hence, the exploration of a shorter holding period becomes financially and strategically compelling. This slide builds on our financial modeling and presents a deeper exploration of the 5 years joint venture exit model. This model was developed as an improvement over the 7 years model discussed previously, with the goal of increasing capital efficiency and optimizing investment returns in a short-term framework. Let's begin with this. The key insight is the rental escalation cycle. With a 15% escalation scheduled every 3 years, the 5th year marks the first major rental escalation. Exiting immediately after this uplift allows private equity investor to capitalize on peak rental inflows, enhancing the internal rate of return without having to wait for the second escalation cycle that wouldn't hit until the year 8. Now looking at the base financial assumptions, the model retains the same construction cost and phasing logic as the 7 years model. Rental income begins from year 2 and scales up to the stabilized 17.93 Cr per half year by year 5. The cumulative rental income paired with a debt structuring supports a financial capital exit in H2 of year 5 at an asset value of 422.06 crore. The structured disbursal of 145.16 Cr in debt throughout equal tranches aligned with construction ensures liquidity during development while minimizing ideal capital. Coming to the performance, the 5 years model base case achieved IRR of 20.57%, which is nearly 4% improvement over the 16.58% IRR in the 7 years model. This demonstrates the model ability to recycle capital quickly and deliver superior quality returns within the typical private equity investment cycle of 4 to 7 years. The final net cash flow at exit stands at 340.78 Cr after clearing a bullet repayment of 98.91 Cr. Let's now examine the sensitivity analysis. The best case scenario assumes a 16.5% rental escalation and a tighter 8% cap rate, pushes the IRR up to an improvement of 23.71%. On the other hand, even if the worst case scenario with a conservation 10% rental escalation and higher 9% cap rate, the IRR still holds at 15.96%. This spread of nearly 8% across scenarios underscores how responsive and realistic the 5 years model is under varying market conditions. The comparison section at the center of the slide clearly summarizes the outcome. The 5 years model outperforms the 7 year model on all fronts. Faster capital recovery, superior IRR, better alignment with a rental escalation, and a reduced risk exposure. Most importantly, it provides predictable returns within a compact timeline, which is highly aligned with a private equity investment principles. In a summary, This 5 years model stand out as the most strategically efficient choice. It is well suited for institutional investor looking for a higher yield, low risk opportunities in India's emerging industrial and real estate sector. Its well balanced structure for rent up and ramp up strategic exit product debt structuring makes it a best fit model in current economic landscape. On this slide, we examine the long-term investment model under a joint venture strategy. Extending the holding horizon to 30 years, this includes two distinct approaches, land purchase and land leasing. Let's begin with the assumptions. In the land purchase model, 109.71 Cr is the invested upfront to acquire the land. The value appreciates at 5% 5% annually, and the exit is planned through a resale at the end of year 30. On the other hand, the land lease model takes more capital light approach with a land leased at 1.25 lakh per acre per year, escalating at 12% every 3 years. Instead of an upfront lump sum, land costs are treated as a predictable operational expenditure. For both models, construction financing is considered with a repayment spread across 8 to 10 years, and interest rates are benchmarked to current market trends. Rent income begins from year 2 and it assumed to escalate by 15% every 3 years throughout the holding period. Now shifting to the actual financial performance, what's most striking here is the IRR difference. The land lease model delivers an IRR of 24.74%, which is significantly higher than 14.5% IRR observed in the land purchase model. This performance boost is primarily due to the difference in land cost structure, which allows early years cash flow to remain strong and reduce financial stress. The less repayment are spread over the adjustable gradually, aligning rental revenue growth. Looking at the cash flow table, the first few years shows heavy construction outflows and debt repayment, similar to the short-term models. However, the absence of 109 Cr upfront land cost allows quicker stability. By year 4, the model becomes cash flow positive, and from year 5 onwards, it generates constant operational surpluses. In year 30, the final net inflow exceeds 108 Cr, reflecting a successful conclusion of the investment horizon. Let's now turn to the comparison infographic on the right side of the slide. This visual comparison puts the 5 years JV against the 30 years land lease model based on the key metrics. The initial capital outflow is significantly higher in the land purchase model, while the lease model keeps it minimal. In terms of IRR, the lease model outperforms, making it more appealing for investors seeking yield maximization. The 5 years model, on the other hand, ensures faster capital recovery, higher liquidity, and limited exposure to the long term risk. However, the 30 years lease model allows investor to ride out market cycle and generate a steady cash flow streams, which is especially suited for a pension funds or a REITs with a long-term income focus. Both models have merits, but their sustainability depends on the investor strategy. For private equity players looking for a short-term returns, the 5 years model is ideal. But for long-term institutional investor willing to manage life cycle assets, the 30 years lease model offers scalability and yield superiority. To conclude, this slide clearly articulates that the land lease model is financially superior for a long-term investments, wherein the 5 years JV model is strategically efficient for PE investors. The balance between return, risk, and capital flexibility becomes the decisioning factor in selecting the right model. To conclude this study, the comparative financial assessment of industrial real estate models reveals that the 5 years joint venture model offers the most practical solution for the private equity investor. With an IRR of 20.57% in the base case, it leverages rental escalation cycle efficiently, ensures quicker capital recovery, and aligns with the standard private equity holding periods. On the other hand, while the 30 years land lease model delivers a higher IRR of 24.74%, it comes with a longer capital lock-in period. making it better suited for REITs or a pension fund seeking stable and long-term income. Looking ahead, there are several areas deeper exploration were needed, like REIT monetization models, valuation benchmarking across tier 2 cities, and ESG linked infrastructure financing. Furthermore, legal structuring of land lease and tech enabled operations will be critical in shaping the next phase of industrial real estate investment in India. Overall, the research lays a strong foundation for the institutional investor to structure scalable, risk-aligned and investment strategies in India's growing logistics and warehousing market. Thank you.